that means you have to be able to pay out 6% of the enterprise value, the whole company, in cash every year. We're talking about highly cash flow positive, highly profitable companies. Now, those are the companies that benefited the least from the Federal Reserve's action, right? The ones who benefited the most were Tesla, where all the profits are 50, 100 years from now, because that's where that discount rate effect matters so much. So if anything, PE positions were probably down more than 20%. They're probably down about 28%. And then, as I mentioned, they're levered. They're not hugely levered, but they're levered about 1.4x compared to similar public companies. So now you're like, gosh, the PE should have been down 40%. Okay, but they weren't. They were down 10%. And why were they down 10? It's because their view, and I think it's not a crazy view, it's controversial, right? But it's not crazy, is just because the market overreacted to COVID doesn't mean that we are obligated to overreact. Now, believe me, I have friends who are in public markets who disagree and say they have to play by the same rules as us, but that is not the way the rules are written and not the way PE interprets it. So their view is, look, everybody lost their minds. They went a little over the top. It was understandable. It was a terrifying situation, but we stayed calm and cool, and we recognized that losses would be meaningful, but not devastating. Okay, if there is another crash, I think you can expect that private equity will smooth out the performance. Now, will the true value of their underlying holdings be only down a little bit? I honestly don't know. I think there's a good argument that if you have a big crash, that it's going to affect the holdings of private equity along with those public holdings. But I think that the returns you'll see on your statements will not be down too much. And we need to match that. If we're going to call ourselves liquid private equity, we have to make sure that we're not down too much. But we cannot use mark-to-model accounting. If our stocks are down 30%, we have to mark them down 30%. So how are we going to protect you and make sure that you only lose 5 or 10% in that scenario, not 30? The answer is we buy insurance. We're going to use the derivatives markets. We're going to buy put options. We have a very sophisticated derivative strategy. I can call it sophisticated because I didn't design it. It was designed by our colleagues at Gladius Capital, some of the smartest derivatives people in the world. They used to run the volatility desk at Citadel, and they're amazing and they run giant institutional portfolios. And so they've designed a hedge that is highly protective against crash scenarios.